According to Larry Williams, this rhythm is the key to profitable short-term trading. After 7 long years of trading, I can honestly say the moment everything changed for me was when I stopped looking at price as random movement and started seeing it as rhythm. The market moves through cycles, phases of expansion and contraction, what some would call accumulation and distribution. Larry Williams says this is the basic key to short-term profitable trading. It's understanding this rhythm. The small ranges are followed by large ranges, and large ranges by small. He was right, because once you learn to recognize these shifts in energy, the moments when the market moves from balance to imbalance, you stop reacting and start anticipating price. In this video, I'm going to show you exactly how I use price cycles and structure together to catch these turns with clarity and precision. These small ranges represent balance. Buyers and sellers both are in temporary agreement, and neither one of them have enough strength or momentum to push it in their direction. This can be identified as price failing to make new higher highs or higher lows. And when it does come outside the range, it comes back in. These zones often become ideal entry points because once price breaks out of this range, comes back and retests it, and shows strength for a confirmation, then you can expect to catch the expansion leg. And those are usually high risk reward trades. This is where accounts are blown if you're not patient. So wait for confirmation. Okay, so on this NVIDIA chart, you can see price broke out of this small range down here and pushed up, creating an expansion leg. Then once again, because of the cycle, it created a small range and pushed back down lower, creating another expansion leg. These expansion legs translate into larger ranges on higher time frames. Inside this range, you can see that price was stuck in this box. Sellers couldn't push below this low right here. Buyers came back in and they still failed to reach the previous high that the buyers got to before. And then price continued to fall, and it fell with strength. You can see the high volume. Came back up, retested it, and pushed back lower once again on high seller volume, and then created the expansion leg lower. This is exactly why smaller ranges are a better place to look for a trade, because once it breaks out with strength, and you didn't have to risk that much. These large ranges are going to represent emotion returning back to the market, with either buyers or sellers taking back control, pushing price in their direction. And once that happens, a lot of other traders are going to panic sell and get out of their positions, increasing the volatility and making price fall further. They can be identified by a decisive break and continuation retest of the small range in that direction, showing strength and once again the high volume we talked about. A higher time frame large range is created by a lower time frame breakout. So once the lower time frame small range breaks out and creates that expansion leg is really price inside of a higher time frame. When both cycles expand together, that's trading in flow and not against it. That's where you find super clean entries with tight stops and a strong follow through. That's where trading is a lot smoother, so you don't get caught in the choppy price action and be stressed out. Ideally, you want to see price push up hard for a short and then start to range at a higher time frame support or resistance level. Once it does that, you want to wait for a break and a retest, and this should be your entry area. Just when it retests, wait for it to show confirmation and begin to push back lower. This trade is going to be a lot smoother when you trade like this and you enter on the small ranges. I blew a lot of accounts trying to call tops and stuff like that, so I suggest just waiting for this confirmation. Now that you understand how the market breathes, the rhythm between expansion and contraction, let's talk about how to actually use it. Every time frame is going to have its own rhythm, like its own cycle of expansion and contraction. The higher time frame sets the dominant cycle. This is the major trend. This is what you pay most attention to. It tells you whether the market is in an expansion phase or a resting phase. Once the lower cycle breaks in sync with the larger rhythm, that's your trigger. Structure, timing, and probability are all lined up in your favor. But the lower time frame is going to show you the micro cycles. This is the small breaths inside the bigger move. And when these two align, when the lower time frame contraction lines up with a higher time frame expansion, that's where you get the high probability setups. So here's what I mean. On the higher time frame, price just finished an expansion leg. On this lower time frame here, we could see price coiling. And that moment is going to be the first breath of the expansion. I always will pay close attention to that break or mark it off, because that initial break is the start of a new cycle, and it's either going to build momentum in the direction of the trend or it's going to trap traders before reversing. Now let's go over an example. So you can see price broke out of this range of price right here. You see this box on this 1 hour. Price broke out of this range, retested, and then went higher. You could see the retest if you go on a lower time frame. You can see right where price tested the low, right here on this 15-minute support area. This now became resistance. And you can see the high volume that came in right there. Gives you added confirmation that you actually have big players that are shorting with you. Could be institutional trades. You can see the 1 hour level right here. Which also translates to a 4-hour swing low. And zooming in closer, you can really see it. Price is really respecting this level. You can really see the huge volume down there also. Could have got in when it broke this box area over here. Also had high volume. But as you can see, this side was the safer option, to wait for this to just come all the way up here and test it on a higher time frame. Price broke right here, you would put your stops above this prior swing high, targeting this prior swing low.
The real question is this: was all this legal? Absolutely fucking not.
Dude had a 3-to-1 trade that pretty much went straight down. It's easy to find these trades in hindsight. Anyone can spot them after the move. So make sure you hit the subscribe button and tap the notification bell so you'll be notified when I go live trading this exact strategy, and you can catch the next move with me, not after it. So that's the rhythm Larry Williams was talking about, the cycle of small ranges and large ranges that drives every move in the market. Once you start seeing price that way, it completely changes how you trade. If you want to take this deeper, I've put together a free top-down trade planner you can grab below. It'll help you structure your day the same way I do, and it's helped me so much. You can also check out my trading journal template on Gumroad if you're ready to start tracking your progress. This journal is going to keep track of all your trade data from your live accounts, your challenges, and your back tests. I'm going to keep them all separate so you can test strategies and see what's working. You can also set goals. So if you're serious about trading, I would highly suggest you pick that up. Keeping track of your trades and the data behind them is crucial. If you want to connect with me directly, you can find me on Instagram, Twitter, and YouTube. Links will be down below. I'll see you in the next video where I'll break down my live trade where I made $7,000 in a few hours trading the London session and show you exactly how I use this simple price cycle strategy and the principles behind it to catch that move. Make sure you hit the notification bell so you don't miss the next live trade, and I'll see you next time.
High volume.
Am I really that much?